Yes, I was at 2 minutes of 10. I was waiting to see if we get our other members, but now it's 10:03. So I'm going to convene this meeting of the Commission on Worldwide Combined Reporting for Unitary Businesses under the Business Profits Tax. Um, I am told that Mr. Foley will be present, but arriving a little late, and I believe that may also be true with Senator Murphy. So we have had 7 active members, 5 of them are here, and I think we should just get going. Uh, so I think that it would be worth taking a moment just to review exactly what our charge is. Very good. I am literally in the opening comment. So, perfect. It was worth waiting the 3 minutes. Welcome, everybody. Okay, we have a full house. All appointed members are present. So, what I'd like this morning is to shape our report, know what it's going to look like, and have an opportunity to critique what each other is saying to the extent that there are differences. And that means that I think we can openly engage in a degree of persuasion if we're inclined, and see whether we move or attenuate any positions. So there are 5 documents that I've just put in front of you, which Gen 4 has graciously copied for us. Those include minutes of the October 2nd meeting, which I guess nobody has read yet, so we might take a pause, read them in a few minutes, and we could then adopt them. Second, there is a memorandum dated November 1st, 2023. This is a skeleton prepared by Gen 4 that shows the style and framework of our report and its captions and cover. So basically, all of our commentary, findings, and recommendations get plugged into this format. Together with that, Jen has prepared a bibliography of cases, resources available online generally on the topic, and additional resources that have been directly presented to us by our presenters at our prior hearings. So that bibliography will be attached and be incorporated into the report itself. So those 2 documents basically give you a preview of the report. Then the 4th and 5th documents, one is have both come from Representative Schamberg. So he's captioned one, Rep. Tom Schamberg, WWCR Commission report, and then he's also got another single-page proponent of WWCR from Minority Report of WWCR. So I know that Tom had contemplated the question whether he would read that to us, and I think instead he's going to leave it to us to read it, but he's got prepared comments he's going to make verbally. Mr. Kennedy and Mr. Foley have been working on the pros and cons, kind of the neutral view of which arguments lie on either side. And when we come to that, they have something to hand out as well. I undertook to do the majority opinion and pull together the report, and that's not ready for prime time. I decided not to put in front of you today what I've already started to put together. And to be frank, I wanted to get the sense of the meeting today, see whether opinions shift, see exactly what Representative Schamberg has presented and Mr. Foley and Mr. Kennedy, and then shape what I write around that. So I was starting to say that Let's just review specifically what our charge is. HB 102 enacted in 2022 basically says the commission shall study the advantages and disadvantages for the state's economy and revenues of replacement of the current water's edge method by the worldwide combined reporting method for reporting and apportionment of income under the business profits tax. It shall consult with national experts in both methods, including economists, business associations, and tax experts. So that is the essence of what we are to do, and I want to keep us focused on exactly that. I think we can say with some satisfaction that we have heard from an excellent cross-section of economists, business associations, and tax experts. A lot of what we have before us is written. If one was to take the time to review the entirety of our record through the videos as well as reading, it's really a very, very comprehensive set of views and opinions and advice. And so there is no doubt in my mind we've satisfied that criteria. So again, the report then, advantages and disadvantages for the state's economy and revenues of changing from water's edge to combined worldwide. So I've done quite a bit of reading since our last meeting. I told you I'd read a lot, but there was still some I hadn't gotten to. In addition to that, we have, in the meantime, gotten the report from the state of Maine. And also Gen 4 found and linked a very extensive report, 96 pages, from the state of Rhode Island. And I'd just like to very, very quickly summarize what I got out of those two reports. First of all, the proposal that was before the state of Maine earlier this year was whether to make combined worldwide reporting optional. They were not proposing, as has been proposed here, to switch to that system as a mandatory requirement. They were simply asking the question, would they allow it as an option? And they concluded that, for many of the reasons we've heard, that it would be difficult to comply with, difficult to administer, difficult to audit. But they also came down quite simply on the point that there wasn't really a good rationale for giving the taxpayer an option. Where you give the taxpayer an option, it invariably works against the state's interest. So we have the situation where we may understand that there will be winners and losers, and we may have no ability to anticipate who the winners are and who the losers are. What's the degree to which they're winners or they're losers, or whether the company that's a winner this year is a loser next year. And they said, when you go to an optional system, basically the taxpayer gets to calculate the tax two ways and choose the lesser, and it always comes out against the state's interest. So I think it's an interesting report. It's a brief one. It's 7 pages. If you haven't read it, you can get through it pretty quickly. And I think it informs generally what the challenges are of the worldwide combined reporting, even though it was viewed in an entirely different context and they decided not to go forward. Rhode Island was a very, very different animal, and I'll just summarize it very quickly. It's about 96 pages. They are one of the states that continues to use a separate entity system, which was the approach that prevailed before approximately 1980. and which the federal government still uses. So there's some very brief commentary in there. It's not a particularly helpful report to us. Let's just say that they also concluded that they would stick with what they have. So they did not move in the direction of unitary reporting. So I think at a certain point here, I'd like to summarize what I've gotten out of all the readings in terms of how this has evolved in the state of New Hampshire. But I think I can hold that, and I want to just take a pause and ask if anybody else wants to wade in at this point and speak to the issue in any fashion. And after we've done that, then I think I'll turn it to Representative Schamberg. Okay, so Representative Schamberg, why don't we start with you? And then Mr. Foley, Mr. Kennedy, will go to you. And I think after that, I think that the volume of material we have received is so voluminous, I don't make the assumption that everyone has had a chance to plow through it. And so at the risk of being somewhat redundant to what you may have read, I would reserve some time after that to just summarize the history for New Hampshire. Representative Schamberg.
Thank you, Mr. Chairman. I have presented, as the chair has stated, as a proponent of WWCR, a basic position that I think should be recognized. And then if someone didn't want to read that, they could read the bullet points, okay? And to simplify it a little bit for someone to understand. But what I would like to do right now is to just make an oral presentation about the reasoning for worldwide combined reporting. And I'm sorry.
There's no time constraint as far as I'm concerned.
Thank you, sir. And it won't be that long, okay? Because I did type it out for myself. The fundamental findings of this Worldwide Combined Commission have found nothing to refute that domestic businesses under Water's Edge method are at a competitive economic disadvantage. As the 1999 New Hampshire Supreme Court volunteered in the Caterpillar decision, they quoted, "We point out the Water's Edge method was adopted for the benefit of foreign businesses." So what we presently have is a fundamental question of the rule of law. There should not be two tiers in our tax system any more than there should be two tiers of justice. If we're going to have two tiers in our tax system, as indicated by the 1999 Supreme Court decision, New Hampshire, then I say this is anti-democratic and anti-free market. It can only erode confidence in our institutions of self-government. In the New Hampshire House Ways and Means Committee, it would be irresponsible of me and my colleagues to fail in the mission to protect a level playing field when it comes to tax policy if we are going to pick winners and losers. I believe the New Hampshire taxpayers would find it unconscionable that we tilt or continue to tilt New Hampshire tax law, the Water's Edge tax method, in favor of non-U.S. corporations. This is the present inequity in our current New Hampshire business tax system. New Hampshire's only sustainable source of revenue is taxes. And taxes play a vital role in our New Hampshire society, for our state, our towns, cities, and counties. all New Hampshire taxpayers have a responsibility to the New Hampshire society. The New Hampshire marketplace, like the rest of America's public marketplaces, provide a top-notch public infrastructure, an educated workforce, critical public services, and the rule of law, and all of these are supported one way or another by tax dollars. Every business, domestic or global, here in New Hampshire benefits from that educated New Hampshire workforce and infrastructures, and all should pay their fair share to support it. We have indicators from the Tax Justice Network, the FACT Coalition, which is called Financial Accountability and Corporate Transparency, and ITEP, Institute Taxation and Economic Policy, and other reporting functions, that the U.S. loses around $176 billion yearly by profit shifting, with New Hampshire missing out on an average of $177 million in the business profits tax. This information is from public data-driven reports, not fear-mongering talking points without providing financial data. There was no statistical data from the Global Business Alliance or the Council on State Taxation about data showing lower BPT revenue, because these organizations know it will result in showing more BPT revenue for New Hampshire. When presentations were made from the New Hampshire Society of CPAs, nothing personal, about challenges of the WWCR that would be faced by practitioners and the business community about gathering information, a new leader has stepped forward. The United States government, under Senate Bill S-638, which was signed into law, that now requires large multinational companies to begin public, country-by-country reporting and operational data to the SEC, not just to the Internal Revenue Service. The required information includes, but is not limited to, a list of subsidiaries, their main activity, their revenue, their profit, their tax, the number of employees, their stated capital, their accumulated earnings, and tangible assets. This information is needed by the United States to improve tax enforcement and arm the investors with information they need to allocate their funds wisely. This new federal approach of country by country will help close loopholes because of tax transparency, and also serves to clarify and standardize reporting requirements. The approach of the WWCR is an accounting method that staves off tax avoidance strategies. But this was received by the New Hampshire DRA with a claimed neutral position. But the DRA implied that ending Water's Edge method and going to the worldwide combined reporting would add additional auditing burdens due to currency and language difficulties. But current New Hampshire law requires companies to rationalize currency and language, just as the federal government requires these companies to do under the new Federal Disclosure of Tax Havens and Offshoring Act. The DRA is the only New Hampshire organization that can take the present Water's Edge tax method and policy and either show it as an impartial tax that ignores artificial legal distinctions among types of businesses, or it can show that foreign multinationals are a privileged class under the Water's Edge method. This privilege causes domestic companies to pay a higher effective tax rate than their multinational competitors. When privileged multinational corporations shift their tax revenue profits, it is the smaller domestic companies that have to shoulder the revenue-raising burden. Since the request for the slow implementation of the single sales factor was ignored without hearings back in 2019 by the New Hampshire Senate, the Honorable Representative Patrick Abrami, who was Vice Chair of New Hampshire Ways and Means Committee, wrote, "We may do significant harm to the financial health of our state. When you take the single sales factor along with the implication of what Water's Edge allows foreign multinationals to do with BPT tax revenues, The state of New Hampshire needs a law implemented which would increase tax transparency. This is the worldwide combined reporting. The WWCR tax policy increases tax transparency and will encourage multinational corporations to steer clear of most questionable practices. We need to put every business, domestic and foreign, on the same level playing field. The state of New Hampshire does not need two tiers in our tax system, one for foreign multinationals and one for domestic companies. Why should this commission oppose fair tax policy reform for New Hampshire domestic businesses when our own New Hampshire Supreme Court has said, we point out that the water's edge method was adopted for the benefit of foreign businesses? Thank you, Mr. Chairman.
Thank you, Representative Schamberg. Are there questions for Representative Schamberg?
If you wait too long, he'll put his hand up.
I'm counting on it. Representative Valerie.
Thank you. I'm reading an article here on from the Tax Foundation, which questions, and I just got it this morning, so I will share it with the committee. But it questions the ITEP information because it for a variety of different reasons, and it also suggests that the estimated revenue does not take into consideration the corporate tax apportionment that exists under the water's edge process. I'm sure our CPAs at the end, well, either one of you two can figure out how that can be put into layman's English. But it looks to me like it's an imbalance in tax rate application to general revenue. Previously, Representative Schomburg has suggested that it is widening the tax base, which may be true, but it also limits the ability of a corporation, therefore, to utilize and move funds, shift funds to areas that it may be more beneficial for the production of a product that may in fact grow businesses. For example, if a corporation is engaged in harvesting hemp, I'm just going to stay away from high-tech stuff, and there's a factory in India that has a very good processing methodology doing on the cotton in the British cotton industry there, where they can process this product better, but it grows better in country A, but the manufacture of it in country B is better, and there's a tax difference between the two countries. Why would the corporation then be penalized for shifting funds from growth to profits from the growth and sale of that product over to the manufacturing side that is located elsewhere? And how does that harm a New Hampshire business that is paying effectively the same tax rate? You indicated in your statement that it was an unequal tax burden, even though we can create, as has been repeatedly said under our Constitution, we can create different classes of taxable entities. I really do not understand that. Can you?
I will try to enlighten just a little portion of that dark area. If they are at a true arm's length apart from each other, and which means A has no connection with B in the management of B's company. true arm's length would be me and you working that deal, not me as your unitary boss, your unitary telling you, I would like you to make a deal with me that is not.
But that's not how corporations work.
Well, I
So-
realize, I'm sorry.
Sure. No, I think Representative Ullery wants to sharpen his question, but please use the mic.
That's not how corporations work. If you've got a corporation that is producing product A over here and then manufactures that product or refines that product or does something else with that product over there, it's still the same corporation. They're not at arm's length. They work together, and by working together, they produce a product that benefits the stockholders in the corporation, and it benefits the people that buy the product. Because it's not, you're not having to produce a profit for each one of the companies separate. You're producing a product that benefits that entire entity that's manufacturing that product. And it seems to me that this tax scheme, all of them are schemes, because taxation is theft. Well, Bastiat said that. But Frederick Bastiat, a French philosopher. But what I'm trying to get at is, why would you penalize a corporation from doing business?
I don't think we're penalizing. All we're looking for is a transparency of, are you truly shifting any of this profit that the state, or tax revenues that the state of New Hampshire should have, for a economic advantage over a domestic company that may not have that ability to deal with that company. I think when you have a unitary setup where you have subsidiaries, you as the top management central core can make and ask for cost differentials that a domestic company, if it was to deal with a company in India, would not be able to get.
Yes.
So what?
I go back to New Hampshire wants to make sure that it is able to provide for the people of this state through its public marketplace, and it can't do it without taxes, proper revenue that should be accounted for in the state of New Hampshire.
Yes. Senator Murphy.
Thank you, Mr. Chairman. At the last meeting, I laid out a few reasons why I didn't support the idea. And I still believe all of those things I said. Probably the strongest reason I couldn't support it, beyond a basic philosophical difference, is what you've labeled as sort of the weakest or least persuasive argument, which is the going it alone. You know, New Hampshire has about 4% of the the nation's population. It's a minuscule amount. Not 4%, 0.4%. Carry the decimal point over. 0.4%. And I can't, to me, that's just a massive reason why we can't even consider this seriously. And at the risk of hurting my own position, I would suggest that if you were to continue to work on this project, and it's something you've clearly been working on for a while, maybe a contingency might be a way to go. If 10% of the country were to support it, maybe this goes away as a reason. So, you know, we have a saying in legislature, and I, folks, you've been here a while as well, never try to improve a bad bill. But this would at least address one of the chief objections that I have.
So I think it's probably worthwhile, at the risk of stating the obvious, to make some distinctions between different kinds of corporations. We have U.S.-based corporations. We have foreign-based corporations. We have U.S.-based multinational corporations and foreign-based multinational corporations doing business in the United States. We have businesses that do no international business but are operating in a multiple of states. And those could be New Hampshire Corporation operating in other states. It could be a corporation from anywhere else, Oklahoma, doing business here. And there are many corporations that are doing business in most of the states, if not all 50, that are not necessarily operating multinationally. So at the end of the day, the common denominator in terms of the New Hampshire BPT is whether they have a nexus with New Hampshire. I'm completely failing to see that you're making a distinction between foreign multinationals and U.S. multinationals. So the suggestion has been made that this discriminates amongst these types of businesses, and specifically that it discriminates against domestic companies. But the water's edge is simply a way of circumscribing where we're applying the unitary method. Okay? So the separate filing method historically prevailed before more or less 1980-ish. A little earlier in certain states, 1980 in New Hampshire. The separate filing method continues to prevail at the federal level. They've never changed it. Goes back at least to the beginning of the 30s. New Hampshire did adopt a unitary filing method. That's what we did in 81. It's the context of the water's edge is not to change the fact that we have unitary filing. It's simply to say that the businesses that a corporate parent may have outside the country that don't themselves have a nexus are not relevant to activity in New Hampshire and therefore not relevant to our desire to tax fairly. So we're not treating U.S.-based multinationals any differently from foreign-based multinationals. So, in fact, the change of law in 1986 was motivated by almost the opposite predicament. So this is subtle, and this didn't hit me the first time I started reading these documents, but on much closer reading, it's become very clear to me from the legislative history of the 1986 law change in New Hampshire that the state of New Hampshire, urged by the Department of Revenue and Governor Sununu, the first Governor Sununu, were trying to resolve a predicament in which the state was discriminating between 1981 and 86. And here's how. When New Hampshire implemented worldwide combined reporting in 1981, they never applied it to foreign-based multinationals. That was shocking to me when I read that. In fact, there are extensive passages in Representative Schamberg's tax notes article that confirm this very plainly. And the commissioner of the Department of Revenue said quite plainly at a Ways and Means Committee hearing in the spring of 1986 that they had never received a tax return from any foreign-based multinational corporation using the unitary method. So they had a conundrum. They had a law that said New Hampshire was using the combined worldwide reporting, but they were applying it only to U.S.-based multinationals, and foreign-based multinationals were just simply skating along, ignoring that law. And the officials of the state of New Hampshire make it plain that that wasn't a situation where the foreign-based multinationals were just trying to get away with something. It was an instance where the state of New Hampshire was completely incapable and unprepared to enforce their own law and audit, etc., against the foreign-based multinationals. So they made it they plainly communicated that they wouldn't even try. So when they came to 1986 after a prior bill, the governor got so directly involved in this that he personally testified on at least 2 occasions before House and Ways and Means on that bill, urging that we move to water's edge so that the discrimination between domestic multinationals versus foreign multinationals could be ended. The purpose of water's edge was to make sure that the domestic multinationals and the foreign multinationals were in fact treated alike. Now, if I'm the CEO of a US-based multinational, I can't see any way in which I'm disadvantaged relative to my foreign-based multinational competitor. We're treated the same. I think where there is at least potentially a grounds for concern and criticism, it's when you come to a New Hampshire-based business that's doing business only in the state of New Hampshire. But those businesses, including the painter we heard from, aren't competing by and large with multinationals. I think it was Mr. Kennedy who asked, what does a business that's based in New Hampshire and operating only in New Hampshire have to gain from moving away from water's edge and back to the worldwide combined reporting? And as far as I can see, the answer is nothing. So I think that this entire proposal is predicated on a conceptual problem. I'm not going to suggest that opportunity is not present for any multinational, regardless of whether it's US-based or foreign-based, to deliberately use transfer pricing for the purpose of shifting profits to a lower tax jurisdiction. Clearly, that opportunity exists. I'm not going to deny that it probably happens to some degree or another. But the fact is, the state of New Hampshire, despite what its law said from 1981 to 1986, has never had or enforced a worldwide combined reporting regime. And that was really surprising and enlightening to me to read. Everybody needs to know that. Despite what was on the books, this state has never implemented unified worldwide combined reporting. And there are reasons for that. So yesterday, I said, why don't I go look in my old boxes and see if I can find. And so here are my souvenirs, which anybody who wants to look at them can. But took me 3 or 4 minutes to find the right box and pull out the briefs that I was on to the United States Supreme Court in November 1983, another brief in October 83, in the case of Shell Petroleum versus Graves, Graves being the executive officer of the Franchise Tax Board, state of California, raising issues that were not actually resolved in the container case, which had been decided at the beginning of October 83. It's very intriguing to me. I'm just speaking personally here, of course. I took a deep dive into this very thorny topic as a young associate attorney with Wilmer Cutler and Pickering in Washington in 1983, and that case closed, and the Supreme Court did not grant certiorari, and I moved on to other assignments. And Here I find myself curiously 40 years later, having given utterly no thought to the topic in the intervening years, and now taking a deep dive once again. And the basic issues and merits haven't changed. The allegations, the concerns that were expressed in 1983 are the same, and they haven't gotten clearer, and they haven't gotten more concrete. So who were we representing? We were representing 20 European countries. And the notion that there was sort of a secret bargain between President Reagan and Prime Minister Thatcher has been suggested. That's really not true. The president's personal memo to the prime minister may have been a confidential document, but the European countries were very actively lobbying against this, litigating against this. President Reagan made it very clear that he would take actions to dissuade the states from embracing or continuing the Unitary worldwide tax scheme. And he did it very openly. A commission was convened with the Secretary of Treasury. A variety of states representatives were involved. And that's what was going on in 1984-85 as a prelude to the 1986 repeal in New Hampshire. New Hampshire was one of those states that had enacted unitary worldwide reporting and then refrained from enforcing it, and then backed off based on the encouragement of the United States government. I'll just digress for a minute to some of the constitutional issues, which I think we can dispatch pretty quickly. There are 4 constitutional issues that I can identify that have been raised at one time or another in the context of this issue. The first one is whether the states could, if they wished, adopt unitary filing, and more specifically, worldwide unitary filing. That has been resolved favorably in the 2 cases in 83 Container and in Barclay Bank in I think it was 94. So there's no question that a state can do this. The second question is the negative commerce clause, which is pretty esoteric constitutional law theory that says even when the federal government hasn't acted, there are still reasons under the Commerce Clause why a state can't take initiative to interfere in the movement of interstate commerce. And I think that's pretty clear that that also is not an obstacle as long as Congress hasn't acted. And in fact, Congress has not acted. But let's bear in mind that the Commerce Clause is a limitation on states' powers regarding interstate commerce and has nothing to say whatsoever about international commerce. The third constitutional issue is one of preemption. So could the Commerce Clause, could the U.S. Congress, under the Federal Commerce Clause, have required unitary worldwide reporting? Yes, they could have, but they didn't. In fact, they wanted to go the opposite direction. And what was, in that context, what was actually going on at the time of New Hampshire's 1986 repeal is that there was a very intense concern that if a bunch of states continued to have a statute authorizing worldwide combined reporting, that would prompt Congress to take action and to preempt in a way that would require separate reporting. So what Governor Sununu stated to the committee, and what the commissioner and the former commissioner as well stated to the committee, is that it would be better to back down, New Hampshire and the other states and not give Congress cause to preempt. In effect, the action of New Hampshire and the other dozen or more states diffused that energy, and Congress, in fact, never did act. So preemption is always possible, but was avoided, never occurred. And the fourth issue, which really I've never seen seriously put forward, but it did get raised by one of our presenters, is a 14th Amendment equal protection argument. And my answer to that is, good luck with that one. That is, in my personal opinion, as a former attorney, has no legs at all. So as Representative Ullery said, the courts have recognized that we can make classes and distinctions for taxing purposes. The fact is, there is no discrimination between a U.S.-based multinational and a foreign-based multinational. Any company doing business in multiple states reports as a unitary entity within the water's edge. Any corporation, whether the U.S.-based or foreign, is allowed to exclude their foreign activities unless they have a nexus. And of course, that nexus hook is not insignificant. It means that you could have an entirely foreign corporation that's selling into New Hampshire and therefore has a nexus. So the reach of our law as it is, I think, far more extensive than the proponents of this proposal understand. And then you start combining that with all the things that have occurred within the last 35, 40 years, including the taxation of foreign dividends and the GILTI, and the reduction of the federal corporate tax rate from 35 to 21%. And I think our report will include a list of some of these mitigating developments. The temptation to abuse transfer pricing to shift profits out of New Hampshire has been substantially mitigated. I won't say it's disappeared, but I can't see it as being a major threat to New Hampshire's revenues. And I think the Tax Foundation article, once again, I would read it. I think every member here should take the time to read that. It just demolishes the underlying presumptions that allowed for IDEP to estimate $170 million of tax that's been left on the table. So I don't know that anybody has a methodology that would allow us to calculate or estimate what that would be, but it certainly is nothing like the 170 million. So I'm going on at some length here because I just think it's extremely important to understand, number one, that we do have unitary filing. Number two, that there is no distinction between U.S.-based multinationals and foreign-based multinationals. Number three, that despite what our law said from 81 to 86, we never enforced unitary worldwide combined reporting. And number four, the governor, the commissioner, and the legislature in 1986 understood that by repealing worldwide reporting and going to water's edge, they were solving a problem in which corporations were treated differentially. Representative Schamberg.
Thank you, Mr. Chair. Just a few questions first. Businesses that file the BPT tax, there's no additional level within that tax filing that says that you're different than the other one. Is that what you're saying? I mean, if I'm company A, domestic, you're company B, multinational, that we're all in the same class when we file our BPT? I mean, we pay whatever the tax rate is, there's no distinction between us, correct?
There is no distinction.
Okay. Do U.S. multinationals through, is it Mr. Kennedy, I think you brought about guilty? Does guilty only apply to U.S. multinationals versus foreign multinationals? Or Mr. Foley, okay.
It only applies to U.S. shareholders of controlled foreign corps. Remember, it's a very specific subset, and I won't go through the whole definition again. But I think your
No.
intention is, does it just hit U.S. businesses and or persons? Let's not forget humans, but yes.
But it's only taxed, that tax is only applied to U.S.-based multinationals, not foreign-based multinationals that do business here in this country.
Well, not necessarily. I mean, if I have what would be referred to as a sandwich structure, which is a foreign parent with a U.S. subsidiary that also owns foreign businesses, then they're subject to guilty on their subsidiaries' activities. So it relates to an ownership interest in a foreign corp. And you can see instances, because I know transfer pricing is so relevant, where that sandwich structure, that foreign corp, the U.S. business has no activities with them. They're a holding company per se because they want to expand X, Y, and Z, and that's how they ended up. So it's always nuanced, but
Going back a little bit here to the ability of domestic versus foreign multinationals. Are foreign multinationals that have subsidiaries here in this state are they able to use accounting techniques that domestics cannot use to reduce their operational costs?
yeah, I mean, whether it reduces or not, are there related party transactions is kind of the core of your question. And in general, yes, sometimes no, right? I mean, I can't speak for all foreign inbounds. If there are related party transactions, the U.S. tax law says we have to use transfer pricing and the arm's length principle of 482 and the regs thereunder.
Just highlight that. That's important. Part of our federal business tax practice is the arm's length, so that adjustments can be made.
Correct, with extensive regulations and the like.
Another question I have is, I guess it's to the DRA concerning some of the statements that have been made. Are companies, are there, let me look at this here. If you look at the full picture, does Water's Edge provision obscure any part of this full picture because companies are not required to account for their operations outside the United States, those that are inside here?
I don't know if we can fully answer that question because what the DRA has visibility of is when the taxpayers file their returns, and if they file their New Hampshire returns accompanying with the federal returns submitted to us, and that's our visibility. Of course, there are the control foreign corporations filing with the 5471s. We have visibility of that as well. So that's our scope in terms of what we could see. I don't know if that answers your question. So.
Going back to Mr. Chairman's constitutional questions, has the state of New Hampshire ever had a decision made on whether the water's edge method is constitutional. Has the New Hampshire Supreme Court ever decided that? Or is it because of a lack of someone going forth to?
I think that the constitutional arguments have been federal, right? So a argument under the U.S. Constitution tends to be heard in a federal court, could have been brought by any of the 50 states or taxpayers within those states. I haven't read the Caterpillar case. I don't know precisely what was presented to the New Hampshire Supreme Court in that case, but I don't think it had anything to do with any federal constitutional issues.
Well, my question is, can the state of New Hampshire, in a single class, BPT, divide and say those that are domestic will be treated differently than those that are foreign multinationals?
So I think the answer is that if circumstances allowed for that kind of a case to be brought, and the distinction was truly based on the nature of the taxpayer as the distinction, as opposed to the nature of the activity, that there probably would be a constitutional problem. But that's not what has occurred in the history of litigation on this subject. And that's why I'm trying to make it very clear that our law does not discriminate between foreign-based multinationals and U.S.-based multinationals. It makes no difference where the parent entity is or where it's headquartered. What makes a difference is where the activity is. And so as to both those types of entities, the activity that's subject to the tax ends at the water's edge. It doesn't make a difference whether it's a U.S. multinational with operations in Europe or a European company with operations in the U.S. The question is, what's the nexus? And your text notes article presents an interesting example of a situation with the state of Delaware. But any argument or concern that transfer pricing is a problem for tax jurisdictions within the water's edge, within the 50 states, has already been resolved by our state's decision to use the unitary method. And so everything amongst the 50 states is effectively neutralized. Everything outside of the 50 states is beyond reach, regardless of where the corporation is based. So again, I think if the distinction was the nature of the entity, you might have a constitutional issue. If the issue is the difference in the nature of the activity, you don't. Representative Dollery.
Thank you, Mr. Chair. Just refresh my memory a little bit here. If you're doing business in New Hampshire, you need to be registered as a New Hampshire business. That's correct. So any entity that is registered as a New Hampshire business is taxed as a New Hampshire business, regardless of the size or their tentacles, if you will, or their international relationships, but they're taxed on what they do in New Hampshire, be it a Joe's pool room, or it's no longer Boston Billiards. What's it called? I forget. But whether it's that type of an operation, or if it's Flair, for example, which sells all over out of Nashville, which sells all over the place, they're still taxed the same because of what the chair just said regarding the type of business that they're engaged in. What they're doing is they're selling this product from New Hampshire. And if I'm not mistaken, that was one of the ground foundations even for the Wayfair decision. And it didn't make any difference where the product was manufactured, but it was where it was sold. So that the activity in New Hampshire is being taxed in New Hampshire, but the activity elsewhere is somebody else's problem.
Yeah, that's accurate. Of course, we have just moved away from a three-factor to a single sales factor. So it's now, under our new law, a question of, the sales activity. Let's also remember that our use of the unitary filing differs from the U.S., from the federal government, which still operates under separate filing. However, our limitation of the unitary filing at the water's edge allows for corporations filing tax returns in New Hampshire to align what they're reporting with what they report to the federal government. Because the water's edge coincides with the United States, the 50 states. A tax filing to the IRS is comprehensive of all activity within the 50 states. New Hampshire's use of unitary filing, but limited to the water's edge, coincides with what the federal government is looking at. So to go back to Senator Murphy's comments, I think one of the greatest flaws in this concept, this proposal, is that it basically asks the state of New Hampshire, with 0.34% of the national population, to fight a battle that none of the other 49 states is willing to fight and the federal government is not willing to fight. To adopt it means we would take so seriously the notion that transfer pricing is being abused that we're motivated to require taxpayers to report to New Hampshire what the IRS doesn't require them to report. That monumentally changes the task for the taxpayer to conform and to file. It monumentally changes the challenge for the DRA to monitor, to audit, and to enforce. So we would lose a lot of the benefit that we currently enjoy in New Hampshire, where the tax return filed by a company with the IRS is the starting point for the determination of their tax in New Hampshire. It's actually, the more you think about it, it would be a pretty wild adventure for us to go off on our own.
Well, Mr. Chairman,
Yes, Representative Schamberg.
I go back to a statement that we tax only the activity that's here. What we tax is upon the reported profits that they earn, not the activity. And if you're able to reduce your reported profits by some methods that others cannot use in the same class, we start to see an unlevel field starting to develop here, or it's already been there. Transparency is very important. And as I stated with Senate Bill 638 on the reporting of country by country, that transparency is now starting to dissolve a little bit. And I think as we go along, we're going to see more and more information come out about how companies operate in what they're reporting. The data you cannot get from the Internal Revenue Service, but you can get it from the SEC. And I think there'll be some comparisons of what is being reported to the federal government and what is reported here in New Hampshire. I'd like to bring up one other point.
Can I just, following specifically on that one?
All right.
No, specifically on that one.
Yes.
If S638, which you have cited, I don't know what the statute number is, if that's just been implemented by the U.S. Congress for the purpose of information gathering and analysis, it's going to take them a number of years to get a track record that they can actually work with and analyze. Doesn't it behoove the state of New Hampshire to let the federal government explore that very, very intricate topic and wait to see what they find out and what they decide to do?
Well, it would behoove us, but there are certain legislative functions that occur in this state that when we asked, slow down, let us do some research like single sales factor, it was just ignored. This Ways and Means Committee did ask for that slow down approach, and it was ignored. So,
Well, I didn't have the privilege of being in the legislature at the time, but I imagine I would have been right there with you on that point.
the one thing I'd like to just bring up before we go any further, even though something has been a law, a tax policy for 37 years, I got my math right? 37 years. The case of Smith versus the DRA had to do with a law that was in effect for 70 years on interstate commerce. And it was found that that law that the state of New Hampshire had was counter to what interstate commerce was. And it had to do with the gentleman being taxed differently in the state of New Hampshire versus where he was filing certain paperwork. And I'm just trying to just sort of say, just because something has been there for a period of time does not mean that it couldn't become an issue for this state. I would hate to see us, the money that the person received was undisclosed. It was in the millions, but it was undisclosed. I would hate to see us step to some place and say, we are not to be worried about this. I think we should be a little bit concerned about the distinctions that we have applied to our BPT class of domestics and multinationals, foreign multinationals out here, that they are being treated differently within the BPT class. Not that they're paying the same tax rate, but this group here has a way to reduce its tax liability to this state that the domestics do not.
So I would agree that the mere passage of time alone is no reason to revisit an issue that was wrongly decided or, the circumstances have changed. And my argument that we not go forward with this proposal has nothing to do with the fact that it's been 36 years. But if you go back and you revisit and understand what motivated the law in 81 and what motivated the repeal in 86, you're going to find that the reasons still stand today. And the state was resolving a problem that we would be stepping back into. The repeal in 86 I'm referring to. Okay. This is the kind of colloquy I was hoping for. I mean, this is a real debate. So before we go on to Mr. Foley, Mr. Kennedy, is there anything further? Does anybody want to ask further questions of Representative Schamberg?
He'll wait till we're in
Okay.
committee meeting.
Well, much of it will be addressed in the final report. So I'm going to turn this over to our two resident CPA experts.
So happily, I think our report will be largely anticlimactic because pretty much everything within our neutral report has already been discussed. You may recall at our last meeting, I had asked if we could kind of go through the bullet points of all of the issues that we discussed. And our report largely just took those bullet points and added some level of narrative to them. I'll pass this out now, and then I think I only need to briefly touch base on a couple of things because most everything in this is largely what has been discussed already or presented here at this meeting, and I see no reason to revisit them. So. So as Mr. Foley is passing these out, I'll just hit on the overall organization. It is largely, again, an expansion of the bullet points that we had discussed at the end of last meeting. And it's organized generally as follow. First section is just generally accepted considerations. The second section is potentially mitigating factors, which the chair had asked us to incorporate and which he had already mentioned. And then the third item is just outlining the items that are both support and are against moving to worldwide reporting. Again, pretty much all of these have been discussed and or expanded on. In terms of the generally accepted considerations, again, that constitutionality moving to worldwide reporting should be allowed. Transfer pricing exists. However, the extent to which transfer pricing may move profits out of New Hampshire is not completely known. New Hampshire taxes foreign income already to some degree, including by the receipt of foreign dividends and by other anti-avoidance provisions in the IRS code, including Subpart F income and GILTI income. Transfer pricing may create an uneven playing field or inequity between companies that have or do not have foreign-related entities. And that currently, because of numerous factors, there's simply not a lot of information to quantify how revenue may be being or profit may be being shifted out, partly just limitations that exist for the DRA, and also partly because the GILTI taxation is fairly new to New Hampshire. The mitigating factors were discussed, which is that there have been various changes since 2017 with the Tax Cut and Jobs Act, including GILTI, the Repatriation Act, and the reduced corporate tax rate, which may mitigate some of the factors with the potential transfer pricing issue. And in terms of items of support and against, again, it's been largely expanded on. The most notable item of support is the theory that this would level the playing field for entities that are only domestic and those that have foreign-related entities. And against would be that New Hampshire would be an outlier relative to moving to worldwide reporting. What wasn't mentioned and was this potential, and the word that was presented was retaliation. I don't quite remember who the presenter was, of foreign companies, foreign countries if we move to worldwide reporting. And then of course the increase in administration and compliance burden for the New Hampshire DRA for taxpayers and businesses and for tax practitioners. And lastly, which was not mentioned that I can recall in today's meeting, is that there may be alternatives to address the transfer pricing issue, whereas New Hampshire does tax GILTI, but it's only at 50%. Potentially, there are other means that could be looked at relative to, instead of moving to worldwide reporting, but to address the transfer pricing, potential transfer pricing issue. So again, rather anticlimactic at this point, but I think next time I'll ask to start, and then we've set the foundation. So, again, I don't know if there's anything
That
to
would have been very wise. Chairman only had an inkling.
So, so that largely is it. I expect Mr. Foley and I will expand on the narrative, as this is mostly in bullet form, but again, this is largely intended just to outline and to add some narrative to the discussions we've all had, both for and against. Sorry,
Thank-
Matt, do you have anything to add?
Well, thank you very much. What's particularly helpful about this is that it's designed to sort of harvest the arguments and catalog the arguments on both sides and not to deny the premise of the advocates. So I think that, we find ourselves in a situation where we do understand how transfer pricing can be used. We understand that it may have consequences and it may be abused, even though it's a perfectly normal and absolutely necessary technique between affiliated entities. We have no way of quantifying it. We're really in an area of uncertainty. Representative Valerie.
And you used a term there, necessary practice, and I had failed to include that in my comments. But yes, we probably need to elaborate on the fact that it is necessary to take monies from here to give it to there, so that you can get this, so you can get that, so that you can get your product done and get it to sale, get it to market.
Yes. Yes, I think that's probably worth stating. Transfer pricing should not be understood to be inherently negative. Transfer pricing is a necessary way of sharing expenses across affiliated entities where an investment is made in one entity that's then realized in another. So the question is, how would we ever set up a regime that that discerns it? And in fact, I think it's a very interesting point that the Unitary worldwide reporting actually doesn't make any effort to identify where the abusive use of transfer pricing is. It's if we adopted this scheme, it doesn't aid us in identifying or isolating or correcting. It's just a very broad, crude way of sort of saying, well, if we all just pool it back together again, then more or less everything will come out in the wash. Treating the issue in that way should be understood as an acknowledgement that we have no way of identifying and isolating and correcting specific abuses. And I think that, again, the Tax Foundation article, I just think is so important to read because what it illustrates is that we have to use certain devices to get our arms around something that's inherently unknown. And, even with the audit powers that the state has, we have a limited ability to get so far inside the books of a taxpayer to know that they have been actually totally compliant on a transactions by transactions basis. So we use a series of devices, and unitary reporting coupled with formulary allocation is just that. It's a device. And the question of single sales factor versus the 3-factor and the various other questions that come up are all about how we shape that device. At the end of the day, even if this was implemented, what we're talking about is instructing the corporations to make a different mathematical calculation. And it's a calculation in which the base of taxable activity gets expanded, potentially drastically, so that the denominator of the math equation becomes vastly larger. But the calculation still has to assign a certain percentage to their activity with a New Hampshire nexus. And the result is that the numerator becomes correspondingly watered down to the point where they're making a calculation theoretically on, worldwide income, where only an infinitesimal little percentage of it is ascribed to New Hampshire. I'm not sure we really get anywhere, and I think that we've read plenty of examples where we can see that some corporations will be winners, some corporations will be losers, And I think that Representative Ullery's shipyard examples were good illustrations of how that can change from year to year and affiliate to affiliate. Why do we want to make the determination of New Hampshire's business tax depend on the vicissitudes of profit and loss in foreign places? I don't see that it makes things better. I think it makes things worse.
If I may,
Of course you may.
I can see why you spoke so well in front of the U.S. Supreme Court, all right?
But believe me, I didn't have the oral argument.
Oh, all right, all right. My background and my personal makeup is that first of all, let me say this, of all our tax policies, of all our taxes we have, there are people that don't like tax rates or like taxes, but we can argue those points. But when I come to seeing something that is distinctly different in how it approaches that class of individuals, the class of taxpayers, I will stand up. I just and say this is not right. And domestic businesses, companies in this state are treated differently than those that have the capability of using accounting methods that our locals can't use. And I hope that individuals and taxpayers understand we want business here, but we want to treat everybody equally, because if you don't treat everybody equally and someone starts getting a benefit, there is going to be others on the other side go, wait a minute, what's going on here? And our reputation as a state becomes affected. So I'm just letting you know where I'm coming from on this. It's nothing personal against any business. It is, let's have a level playing field.
Thank you. You're illustrating a challenge that we're going to face in writing this report, and that is that I fundamentally disagree that our law treats different classes of taxpayers differently. It is inherently true that a company operating entirely within New Hampshire doesn't have affiliates in other states, let alone in other countries. It's inherently true that a business that doesn't have affiliates is not in a position to use transfer pricing. That is not a product of our law. That's a product of their circumstances and organization. Our law is in fact neutral. It's a very important point, and as I say, I'm going to be taking pains to try to explain that in the report. Representative Ullery.
No, you just,
Covered the base?
well, yeah, and there still hasn't been a clear definition as to how they're treated differently, just because one is, as you just indicated, is a larger entity having an ability, it's grown, it has now, for example, there's a law firm in Manchester that was New Hampshire only. Now it's got an office in Brazil and it's got an office in London. They grow, businesses grow, and now they can take advantage of a bunch of other activities merely because of the size of their operation, even though the same basic laws within New Hampshire apply, period.
Thank you for that. Yeah, it's an interesting, nothing static. Corporations reorganize, merge, grow, open up new units. It's very hard to say how a particular taxpayer that's affected in a certain way today might be affected in 10 years.
I still say that it's giving a tax advantage to a group in a class. And has nothing to do with how they go about their operational of their business. It is
So-
still a tax advantage.
Let me pose a question.
Oh, I'm sorry.
If a taxpayer makes a major capital investment and they then avail themselves of the allowances for depreciation, and they thereby gain a tax advantage by being able to offset some of their income with their annual depreciation allowance, whether we're talking about 3-year, 5-year equipment, 40-year commercial real estate, isn't that really analogous to what you're speaking of?
If the other company can do the same thing in approaching how they invest or take advantage of their depreciations, I would say yes, but I don't see domestics being able to take advantage, the same advantage that foreign multinationals can take when it comes to the reporting of their business profits tax. That they have devices and accounting that can't be used by the domestic companies.
So certain businesses are inherently capital intensive. Right? Let's say a ski area is particularly capital intensive because it has the fixed initial investment of purchasing its side of the mountain. Has to have a chunk of real estate. It's going to depreciate it. Or a company that's heavy in manufacturing equipment may have leased facilities, but still may have major capital expenses in the heavy machinery. It's just a question of using the tax laws for the circumstances of that particular tax filer. And I simply fail to see how any company in New Hampshire couldn't start doing business in another state. I can't see how any business in New Hampshire could not organize an affiliated corporate entity or have subsidiaries. All of these choices are available. It's a question of the needs of the company.
But when they incorporate like that in other states using a subsidiary, they still under water's edge. There are certain restrictions that they have that foreign multinationals do not have in how they file and how they use the tax system as we developed it.
So I think I'm struggling to get you to see a different delineation.
That's why my report's going to be different than yours.
Well, that's fair. But the water's edge applies to the unitary requirement limited by the water's edge applies to any company, whether they're foreign or domestic, that does businesses in more than one state, 2 or 50. The limitation of the water's edge applies equally to any business that's doing business in the United States or abroad, and it's not limited to foreign multinationals. It's any multinational. So the distinctions you're drawing aren't valid.
I'll have to think about that.
We're all going to. Okay. This is going to be a very tough report to write. That's why I began by apologizing for not having a draft in front of you today. What more would we like to accomplish this morning? And do we believe we need to meet again? I'm thinking probably yes, but theoretically we could wrap up our business, virtually. But we have a tight timeline. It's November 1st. I've personally held open the next 2 Mondays just in case. I would like to think that if we meet again, we can probably have drafts in front of us and wrap it up in one meeting. But having said that, could others chime in?
23rd would be fine. Same time, same place.
I will not be in state on the 23rd.
Okay.
30th is fine.
Others? Neither?
Either one.
Oh, either. Okay, excellent.
Um,
If we have drafts circulated that we can work on and meet on Monday morning, October 30th, 10 a.m. here, we would then have 2 days to the close of business on Wednesday, the 1st, to file our report. Can we make that work? I think the real onus is on me. I think Representative Schamberg, you've done good work in putting your advocacy piece in.
And I probably will send a revised report now.
Sure,
Okay.
absolutely. Feel free. Okay, and Mr. Kennedy, Mr. Foley, you're going to flesh your section out a little bit more, and we may want to go back and forth a little bit in terms of seeing how that folds into the bigger report.
Yeah, I had presumed that our report would be mostly to the committee and not be presented outside of the committee, but incorporated into the final report. I presume that's still the plan.
Yes, yes. What you're doing is helping towards the draft of the commission's report. Mhm. And as you've seen from the template that Gen 4 prepared for us, our report will be transmitted to the Speaker, the President of the Senate, House and Senate clerks, the governor, and the state librarian under a cover memo from me, and will come jointly from the 7 of us.
So I'm clear on the date. We talked Monday the 30th or Tuesday the 31st?
Monday, the 30th.
All right. I do have a conflict at that time,
You
but
do.
it may be the only time.
Is there a different hour?
It's largely an all-day event.
May I make a suggestion?
Yes.
The 23rd was good for the rest of you except me, correct? And you're going to be putting yours together. Why not meet on the 23rd, if you wish? And then on the 30th, we'll have my draft will be in your hands before then.
Mm-hmm.
We need everyone.
Yes.
Everyone needs to be here.
I think 6 is a quorum.
I think we have 12 members, so we need 6.
Okay. All right. So I am advised, fortunately, I have a good advisor, that we need to have all 7 of us present in order to have a quorum to conduct business. So it is important that we pick a day and a time that works for everybody.
Well, we don't need all 7 present, just a quorum present.
Don't count again. So the legislation provides for 12 members. We currently do not have 12 appointees. But the 7 that we do have appointed comprise our, so we need all of our current.
Let me ask this, Jen. Would we need all 7 here just for the work session? Without a decision being made, and then the 30th, come back in and have all 7 or the 31st for a decision making?
I've got good news. The statute that authorizes us in Section 4 includes this sentence: 6 members of the commission shall constitute a quorum. Okay. So what do we think about Representative Schamberg's idea that we get together next Monday, even though he won't be able to be with us?
I think it's a good idea. I think it would be a good idea for wordsmithing and the incorporation of the CPA section so that they know exactly how it's going to fit in. And then we can just include on the next Monday their section. We can have some more wordsmithing between the 2 of us and include Representative Schomburg's counter proposal, and we'll.
I think that's valuable. It gives us 9 days to then pull it together. It also, let's be frank, keeps our chairman's feet to the fire.
You've turned the heat on in your house already?
Okay, so unless there's anything further that anybody would like to add,
Monday the 23rd.
Monday the 23rd, 10 a.m. here, and Jen, we can work with Karen to get that noticed.
Will that be called a work session?
A
Okay.
regular commission meeting.
And what about the 30th or the 31st for the final? Are you gonna, because Kevin can't make it.
Well, let's hold the 30th. We might even want to notice it and then cancel it if we don't need it. So the next 2 Monday mornings at 10 a.m. Good. Thank you very much. Adjourned.